Welcome to ACCA F9 Financial Management. I'm called John Tende once again. I can be reached on john.tende@gmail.com, or you can find us at Management and Financial College. Our website is www.mafuganda.com. Now, today we are going to be looking at an interesting topic, which is business finance. Now, this is a key examinable topic in F9. So, what is business finance? Now, every business needs to fund its investments in order to earn a return for its shareholders. Remember, the main objective of a business is to make money for its shareholders. So, there are various forms of finance available to businesses, and these can be categorized as short-term finance, which is typically 2 to 3 years. Long-term finance, which is typically over 5 years. And finally, we have Islamic finance, which is of growing importance in the international financial markets. So let's briefly look at short-term finance. There are various forms of short-term finance, and these include overdrafts. Now, an overdraft is a facility which allows the customer to withdraw below the minimum amount on a current account. Interest is then charged on the overdrawn amount. The key advantage is that interest is only paid on the overdrawn amount, and there is flexibility in the repayment terms and also in the acquisition of the facility. However, the main drawback is that overdrafts are repayable on demand. Next, we have short-term loans, which are basically for a fixed amount and a specific period. The key advantage is that repayment schedules are fixed and the customer can plan their cash flows better. The main disadvantage compared to overdrafts is the lack of flexibility. The other key source of finance is trade credit, which is simply purchasing for goods right now and paying for them at a later date. However, you should know that delays in payment may worsen the company's credit rating. The other key source of short-term finance is called leasing. So here what happens is that rather than buy an asset outright, a business may lease the asset. So this involves renting the asset from another party and paying rentals. Leases can be operating leases, where the lessor retains title to the asset, or they can be finance leases, where the lessee or the business obtains title at the end of the period. Then we have sale and leaseback. So this involves selling property, plant and equipment, and renting it back from the purchaser. Now, a lot of cash can be raised from this transaction. The only problem is that the company loses title to its assets, which further impacts its future borrowing capacity, as there are fewer assets to use as collateral. Then we have something called business angels. A business angel is simply a wealthy individual who is willing to provide capital to a business, usually with very flexible repayment terms. So a business angel could be a friend, it could be a relative, or it could be a colleague. Now, sometimes they may want an equity stake in the business at the end of the loan period. Next, we shall briefly look at long-term finance. Now, there are various forms of long-term finance, and these include bonds. Bonds are a form of long-term debt. We're going to look at bonds in detail. Then we have something called venture capital. Now, venture capital is risk capital provided in return for an equity stake in the business. We're going to look at in detail what venture capital is. And then we have equity finance. Now, equity finance is simply ordinary share capital. So we are going to look at methods of obtaining ordinary share capital. So let us briefly look at bonds. Now, we've noted that bonds are a form of long-term debt. For example, loan notes and debentures. Now, for purposes of F9, loan notes, debentures, loan stock all relate to the same thing. So in an exam, when you hear anything related to loan notes, bonds, debentures, and loan stock, they all refer to the same thing. So basically, they are a form of long-term debt. They are usually secured, and interest is paid annually or semi-annually. Now, bonds can be irredeemable. Now, this means that interest is paid in perpetuity. That means interest is paid forever. Or they can be convertible. Convertible means they can be converted into equity, into ordinary share capital, instead of repayment at the end of the loan period. Or they could be redeemable. That means that the capital is repayable at the end of the loan period. Next, we shall look at venture capital. Now, I told you earlier that venture capital is risk capital provided in return for an equity stake. So usually, the venture capital firm will want an equity stake in the company and a seat on the board of directors. Now, the nature of ventures which are usually funded might include business development. So this is where a business wants capital to expand its production line or enter new markets, or perhaps develop a new product. So you can seek venture capital to fund business development. It could be a management buyout. Now, a management buyout is where management buys part or the entire business of a company from its owners. So that's a management buyout. Or it could be a startup. So usually a startup is a new company, but usually they will want a promising company which has potential high returns, and usually they would want an innovative product and highly motivated individuals with strong entrepreneurial spirit and skills. So usually we're looking at technology startups, internet startups, for instance, firms like Facebook, firms like Google, all had to get venture capital to kickstart their operations. So venture capital firms will usually require a high rate of return. That's why they usually go for high risk and high profitable businesses which are usually innovative. And this return is usually realized through a stock market listing. For instance, the recent listing of Facebook. So the guys who initially invested in Facebook had a chance to realize the returns by selling to the public through an initial public offer. Now let's look at equity finance. I told you equity finance is simply ordinary share capital, and it is raised through the sale of ordinary shares to investors. There are various ways of raising equity finance, and the main ways are through a stock market listing. A stock market is simply a regulated market for buying and selling shares by the general public. An example is the Nasdaq, which is an electronic stock exchange in the USA. So there are various stock markets around the world. So you have the Nasdaq, you have the New York Stock Exchange. In Africa, you have the Johannesburg Stock Exchange, the Nairobi Stock Exchange. So all these are stock markets, and you can raise finance through a stock market listing. We're going to look at different ways of listing on the stock market. We also have something called a rights issue. A rights issue is an offer to existing shareholders, usually at a price lower than the prevailing market rate. So we're going to look at some few computations relating to the rights issue. We have something called a stock split. A stock split occurs where, for example, each ordinary share of $1 each is split into 2 shares of 50 cents each, thus creating cheaper shares with greater marketability. So psychologically, a share of 50 cents is cheaper than a share of $1. So it's mainly done to improve the marketability of shares. Then we have something called a bonus issue. So these are shares which are issued out of reserves. So it could be retained earnings or some other kind of reserves within the balance sheet to existing shareholders in proportion to their stock holding, and there is no additional cost to the shareholder. Now, this might be done for regulatory purposes. For instance, some banks in most areas have minimum capital requirements. So to meet those minimum capital requirements, they may issue bonus shares or else scrip issues. So a bonus issue means the same thing as a scrip issue. Now let's look at stock market listing. Now, why would a company seek a stock market listing? Now, there are various reasons for this. It might be because of improved marketability of shares. So as an investor, it's less risky to buy shares in a quoted company rather than in an unquoted company because of the better regulation and better compliance. It might be to get a better public image. Listed companies generally have a better public image because they're subjected to greater oversight and regulation than unlisted companies. It might be for better acquisition prospects. So a company which is listed may form a better target for acquisition by a bigger firm. So better acquisition prospects. It may be that the initial founders or investors would want to realize their investment. I gave a simple example of the initial investors in Facebook who recently realized their investment from the recent IPO of Facebook. And maybe to access a wider pool of finance. So usually stock market listings can raise a lot of money. For instance, Facebook, which raised several billion US in capital. Next, we shall look at the methods of obtaining a listing. Now, the first one is called an initial public offer. Now, an initial public offer is an offer to the general public for the first time based on information contained in what is called a prospectus. So a prospectus will have a summarized performance and a detailed financial statements of the company, for instance, for the last 5 years, to have projections of growth, profit figures, to have the business model, and generally talk about the business. So a prospectus will be used by investors to evaluate whether that IPO is worth it or not. It could be through what is called an introduction. An introduction is simply obtaining a quotation from the stock market. Now, you must know that no shares are sold to the public. This may be done to obtain a share valuation and hence enhance the marketability of a company's shares. Then we have something called a placing. A placing is an offer, this time to a smaller number of institutional investors. Now, this could be pension funds or insurance companies. So 3 forms of listing: the IPO, which is an offer to the general public, an introduction, which is simply the stock market granting a quotation, and finally a placing, which is simply an offer to a few institutional shareholders. Now let's look at the rights issue. Remember, the rights issue is simply an offer to existing shareholders for additional shares at a lower price. Now, with ACCA F9, there are usually some computations which are expected of you relating to a rights issue. Now, when a company offers a rights issue, there are three general options available to the shareholder. Option 1 is simply to do nothing. So simply do not participate in the rights issue. So we are going to say that if you do nothing, you end up losing wealth. You may exercise all the rights. That means you purchase the additional shares at a discounted price. In this case, you neither gain nor lose wealth. And then the third option is you simply sell all the rights. So you sell the right to purchase the new shares at a lower price. In this case also, your shareholding falls, but at the same time you neither gain nor lose wealth. So three options available to the shareholder. Do nothing, in which case you lose wealth. Exercise all the rights, in which case you neither gain nor lose wealth. And then sell all the rights, where you still don't make any loss or gain. So we're going to briefly look at those options and the related computations. So for instance, let's take a 1 to 3 rights issue. Now a 1 to 3 means that for every 3 existing shares you get 1 additional share. So each additional share is priced at $3.2 per share. So let's try to evaluate for someone holding 900 shares which are currently trading at $4 per share, what would happen in the first option. That means doing nothing. Now we need to first compute what they call the theoretical X rights price, basically the price at which the shares will trade immediately after the rights issue. Now to do that, we need to calculate the weighted average of the shares. So initially we have 3 shares trading at 4.0, and these are going for $12. So we have 3 shares, okay, each trading for 4.0s, and they're going for a total of $12. And we're purchasing 1 additional share at 3.2, which is the issue price. So 1 by 3 equals 3.2. Okay. So 3 shares plus 1 share gives you 4 shares. And 12 plus 3.2 gives you 15.2. So the theoretical X rights price is 15.2 out of 4, which gives you 3.8. So 3.8 is what they call the theoretical X rights price. So we need to evaluate just before the rights issue what was our wealth, and just after what is the new wealth. So before we had 900 shares, each trading at $4, which gives us $3,600. Now after, the shareholding hasn't increased, okay, but the shares are trading now at 3.8, which gives us 3,420. So you can see that there is a loss in wealth of $180. So if you do nothing, you end up losing wealth. Let's look at the second option, which is exercising all the rights. Now before, we had 900 shares trading at $4, giving us 3,600. We have an additional investment. Now remember, for every 3 shares held, so the new shares subscribed to are 900 out of 3, which is 300. And we're purchasing each at 3.2. So this gives us 960. So the total wealth is 4,560. Now, the wealth after the new shares are now 1,200. That's 900, okay, plus 300, which are now trading at 3.8, the theoretical exercise price, which gives us 4,560. So you can see that there is no gain or loss in wealth. So when you exercise all the rights, you neither gain nor lose wealth, but you've increased your investment in the company by 300 shares. Now let's look at option 3, which is selling your rights. Now we need to know the value of the rights. Okay, so the theoretical exercise price was 3.8. The issue price was 3.2. That means the value of the rights per new share is 0.6. So 3.8 less 3.2 is 0.6. So the sales value of the rights. Now remember, for every 3 shares held, okay, we're given 1 new share. So the new shares are 900 divided by 3. Each is costing 0.6, which gives us 180. So I can sell my rights to another person. Now the market value of 900 shares, X rights, remember we are multiplying 3.8 by 900, which gives us 3,420. So the total wealth in this case is 3,600. Now the total value of 900 shares before rights, we're multiplying 900. We're multiplying 900 by 4 to give us 3,600. So again, you can see that the gain or loss in this case is still 0. So 3 options. When you do nothing, you lose wealth. When you exercise the rights, there's no net change in your wealth. And when you sell all your rights, there's still no net change in wealth, but your percentage shareholding has decreased. Now let's briefly look at Islamic Finance. Now here what you need to know is simply briefly what it is. Okay, they're not going to ask you any detailed questions. We have something called the Mudaraba. Now the Mudaraba is simply a partnership where one partner provides capital and the other expertise, and both sides share in the profit and loss. There's something called Musharaka, which is a form of equity where both parties bring capital and expertise and share in the profit and loss. There's something called the Murabaha. The Murabaha is simply a credit sale, so you buy goods now and then pay for them later. However, the product involved must not be prohibited by Sharia law, so it can't be anything like alcohol or drugs. There's something called Ijara. Ijara is simply a lease. So a lease is simply a contract where one party allows another party to use his asset in return for a rental fee. A lease can be either an operating lease or a finance lease, as we've already seen. There's something which is called sukuk, which is an Islamic bond, which is similar to the ordinary bonds we've already looked at. The only difference is that there is an underlying tangible asset that the bondholder shares in the risk and rewards of ownership. So this gives the sukuk properties of equity finance as well as debt finance. So Islamic finance, 5 contracts: partnership, equity, credit sale, lease, and bond. The key principle behind Islamic finance is that interest is prohibited. So all these contracts are are formed in such a way that interest is not very explicit. So there you have it. That is Islamic finance. So in summary, business finance can be short-term finance. We looked at various forms of short-term finance. We looked at overdrafts. We looked at short-term loans. We looked at leasing. We looked at sell and lease back. And then we looked at business angel financing. It could be long-term, where we looked at bonds. Bonds are simply a form of debt finance. We looked at venture capital, which is basically risk capital in return for an equity stake. And then we looked at equity, which is simply ordinary share capital. And finally, we looked at Islamic finance. Now, various forms of Islamic finance. We looked at the Mudaraba, which is a partnership agreement. We looked at Musharaka, which is a form of equity. We looked at the Murabaha, which is simply a credit sale. We looked at the Ijara, which is a lease. And finally, we looked at the Sukuk, which is an Islamic bond. Okay, we've come to the end of this session. Thanks once again for subscribing to this video. Remember, you can give us feedback on email address john.intende@gmail.com. Okay, wish you all the best in your studies, and let's meet next time. Thank you.